I'm Charles Goddard, as I have been for many years, and I'd like to welcome you to an introduction to the 5 power lessons to stock market mastery. Now, this is meant to be just sort of an overview, and what I'm hoping to really bring across to you is the different approach I take teaching, trading, and investing versus others out there. So we're gonna target a couple things, and I'm also going to leave you with some items that you can use right away, including a basic trading method that you can employ immediately. And it's a method that I demonstrated for during the year of 2020. Traded this basic method only with 5 symbols only, and I record them in my book that you will receive as part of this course. And I also recorded them on a blog. There's a PDF available if you hit the Get More Details button down at the bottom of this page, and you can get that for free. And you could take a look at, and just so you know that this is just not me talking. I actually did this. I listed the trades in many cases, as you'll see, before they happened, and how we did, which was basically 42% for the year. And believe me, we took no undue risk, and we were very limited in what we did. And I'll demonstrate that method for you on this video. So let's rock and roll. Before we do that, let's take a quick look at me. There's that handsome devil on your screen right now. And to the right of me, you can see some of my designations. And on top of those, I spent thousands of dollars and many hours in the company of veteran traders in workshops and as a one-on-one student. And they taught me that for all the book learning I might have, having a practical approach was just as important. And I think that's what I bring to my teaching as well as my own trading, and that is a balance of the two. Okay, let's start off with who will benefit from my course. And so, first of all, brand new people to trading investing. You will get off on the right track. It doesn't matter if you don't know a stock chart from a burnt biscuit. We are going to start at burnt biscuit and work our way forward. Struggling traders. Well, I already know what your problems are, so we're going to deal with those in the course. And if you're listening, I promise you will improve your trading. Then we have investors who currently have a professional on the job at the moment. You too will benefit, as I'm going to show you that you should take control of your money, that you don't have to be a buy-sell kind of person. You could take a longer term approach. You could use broader based investment vehicles, and I promise you will do a better job than whoever you've got handling things for you at the moment. All right, classic exploding ahead. Trading world versus world of trades. Subjective trading versus objective trading. What does the heck does all that mean? And you will understand it, hopefully by the end of this video, but certainly by the end of the course. And you'll see why it is key if you expect to transition to the 10% of traders who are consistently profitable. So let's take a couple of examples of what I mean, just to get us rolling in this thought process of the difference between subjective and objective. Okay, so one of the things that's going to separate you from the many is your targeted approach to what you're trading. And I have elsewhere told you Dennis's story, which I do like to tell, and I just might include it again in the course just because I do enjoy it. But an example of the subjective trading world is how people go about searching for what they're going to trade, and hit or miss, it's a scattergun, it's whatever. I actually know of a guy a few years ago who mortgaged his house, and he went around and asked people at the office for stock tips. What should he invest his money in? And needless to say, it didn't work out well for him. So I'm going to show you two ways that I go about finding trades, and I will deal with these in the course. And so here is an example. I have 20 symbols. 20 symbols. They are stock indexes, they are commodities, there's a couple of cryptocurrencies in there, and I look at these every day. And as soon as I call up this particular chart, let's say of the S&P 500, which is what we're looking at, immediately, if there is a stock chart pattern that is there within the price movement, it shows up. And so I use this system for finding patterns. You can see the candles to the left of those two white lines of different colors. They are also candle patterns are identified for me. So out of those 20 symbols, if I see, for example, in this case, I would have had a signal right in here to buy, and what you don't see on the screen is there is actually a target for this pattern up in here somewhere, and so I would buy based on this pattern. It looks good to me, so I would just buy based on that pattern. I'm not reconsidering. I'm not doing a bunch of thinking. The last person that I need thinking about stuff is me. So I just want to take I want a systematic approach to entering trades. Here we've got a symmetrical triangle. It's a bullish pattern, and my purchase will go in here, and my stop will go on the other side down here. And what you can see in here at the same time is a mini head and shoulders, which is actually a bearish pattern, but it looks kind of clumsy, so this one doesn't affect us. We do have to have some say in this, despite what I just said. That is not really head and shoulders to me, so it's not like I wouldn't take notice if it was a head and shoulders. It looks like a stretch for it to be a head and shoulders pattern. But that is how I do it from that point of view. And now I'm going to show you one more way that I hunt down trades. The trading method I'm going to show you in a few minutes is based on moving averages. And one of the ways that I, in my objective world of trades method of working, is that I have set up a scanning system on this charting service. And what I've told the charting service is that I want to know when stocks fulfill the conditions of the basic trading method I'm about to show you. And just in broad strokes, it is that the blue moving average, this one here, which is a 21 moving average, is above the 55, which is the green, and that dictates our trend for us. This is an uptrend, and then I want the price or the red moving average, which is an 8, to have crossed above the blue. That is a buy for me, assuming a couple other conditions that I'm going to tell you about in a minute. But I have built that into this service, and over here, so each day I will go and I'll say, okay, give me all the stocks that show up under my conditions that I'm looking for, and here are the ones that have appeared on this day, which is I think the 6th or 7th of April. And this is the bullish side of the trade. There is also the bearish, where we've got it in a downtrend and the red line goes below, and so on. So this is an example of how you systematically look for your trades. You don't just search around and get your dartboard and your monkey and your and so on, and there you do things systematically. This is how people do it who are successful traders. They have their process, and they're systematic as it when in turning up their trades, and we dig a lot more into that in the course. So what I'm going to do is, as I build towards teaching you one basic method, we're going to end up covering a couple of topics that come up in the course that are key components to your trading, and for you to be in the world of trades and to be in the objective world of trades instead of the hit and miss. So this is a copy of a chart from stockcharts.com. You can get this for free on the interweb. This is a candle chart. You can see down here you've got drop-down menus that you can add the various attributes you may want on your chart, and we're going to take a look at the finished product and what I use. Here's my charting service, the main one that I use, and this is my basic setup, and it is fairly simple. You can see it's pretty clean, and if you were to hold my feet to the fire, I'd tell you I prefer point and figure charts, but I will show you those in the course, and just the beauty and the simplicity of the supply and demand that drives a point and figure chart, which really is all there is when it comes to the markets. But having said that, not many charting services do point and figure properly. So by keeping things basic and simple, you know, and I know that this setup can be had anywhere at any time, so I can review things. I've not made things too complicated for myself. So we've got three moving averages, as I've mentioned, a 55, 21, and an 8. Those are my core moving averages. They're all Fibonacci numbers. Then we've got in the top pane up here, we've got rate of change. That's the energy driving price, and we'll talk about I'm going to demonstrate that in a minute, how I use that just very quickly. We go quite deeply into that in the course, and down here we have the relative strength, and how we use that, not in the way that you get in the definitions, because mostly these two things, especially the RSI, is used as an overbought, oversold reader, whatever you want to call it. And for me, I just don't get that. A price can move a lot while your oscillator still shows overbought or oversold. So I'm going to show you in the course how to use the relative strength index to tell you whether what you're looking at has moved from a bull to a bear or from a bear to a bull market, and that is far more useful. I'm also going to show you in terms of rate of change. We're going to hit on divergence in a minute, but I'm going to show you in the course how you can use the rate of change as a leading indicator to get you into trades in a systematic way. And as I showed you the scan just now for this setup, I also do a scan for anything that fits the rate of change trade as well, and I'll show you all that. I teach you all of that in the course. Okay, so here we've got our basic setup, and now I'm going to demonstrate to you the basic trading method that I promised to you. So what we've got is we've got the 55, which is the green moving average, the 21 is the blue, and the 8 is the red. And what we do first of all, let's just deal with this orange moving average here. It is actually 233, which again is a Fibonacci number, but I one of the things that I like to center on is some of the practical stuff. And a lot of professionals pay attention to the 200 period moving average, not necessarily the 233, but they have the 200 on their charts, not because they use it a lot, but they know that big pools of money like mutual funds, pension funds, and so on, some of their computers are quite often mandated to buy or sell as the price crosses the 200 moving average. So they like to pay attention to where that is. And that's the sort of thing that we're going to deal with in the course. How professionals act, and how they also will trade against you. And I'll show you some of the things that they watch for that tells them that the beginner brigade or the struggling brigade or whatever kind of brigade you want to call yourselves, where they are likely to place their trades, and those guys are ready for you. But in the meantime, let's get back to our trading method. So here we're going to start down in this little section down here, and you can see that we've got a bit of a down, and we've got our moving averages set up this way, but the setup we're looking for is over here, where the blue has moved above the green, and in our world we're going to call that an uptrend. This gives us the ability to go with a long trade, a trade to the upside. And before you think, oh, that sounds obvious, it's not obvious, because I was looking at a course recently where the guy is telling people that they can actually buy on a downtrend and get out, buy, get out, buy, get. I've never heard anything as ridiculous as that in my life. But anyway, so here we are. We've got you can see we're just entering an uptrend right in here, and now we're looking for a trigger. We've got our setup. Our trigger is the red moving average, and the price moving above the blue moving average, and that occurs right here. So what's our next step? Because we're almost golden here, is that we look to the left, and we're looking for a price higher than where we were going to get in, and that occurs right here. And this is a level of resistance, and we hammer on this in the course: resistance and support, for good reason. They tell us a lot, and so let's dwell on a couple of those things right now. So just above this level, there are a bunch of stop buys building, and the reason that they're building just above that level is because once the price goes through this level, it cements the idea that the trend is continuing on up. And so this is why quite often where you've got resistance, when it is broken, the price will quite often run like a stabbed rat, and we want part of that. But what we don't want part of is to have our price bounce off resistance and back and forth and so on. We want to get in a trade that is headed somewhere. Now, why would it bounce around? Well, because resistance levels are also, you know perfectly what was going on here. A lot of people who got in at this high price here, they're not happy now that this price has declined, and you know what they're thinking. They're thinking, well, as soon as that price gets back to where I got in, I am getting out. I learned my lesson, and that happens over and over and over again. So the fact that the price breaks through this resistance is good for us on a bunch of fronts. So what we're looking for here is we're looking for a close, not a cross, a close above resistance, and we will put our buy-in just above the candle that closed above resistance. Then the next question you have is, well, where are we putting our stop? Because that's the other thing that separates the professionals or the successful trader from the average person who is struggling and is 80% of the time losing money, about 10% break even. But so they do not use stops. The number of people I talk to don't even know what stops are, and it's sort of like an amazing thing to me. And we go through stops a lot, whether it's a trailing stop or a static stop. And what we're looking for now, where we're going to put our stop is just under support. It could be here, could be here. For me, this is a good enough spot. This is not really that great a support area, but it's good enough for me. So we would put our stop in here. If you're cautious, you would go under here. And why? Because if support is broken, it means the trend is in jeopardy. It means our trade is in jeopardy. That's where we could be wrong. So we want to get out at that point. So we've got our stop in. Sorry, let's cancel that. That's actually not strong enough. Let's put our stop in under here. And our trade is underway, and up she goes like that. Look at me, I'm a regular little Rembrandt here with this thing. And we get a little pushback here. And why is that significant? Well, because I go through this, and it's because if we came upon this setup where the blue is above the green and the red has been pushed back under and is now coming back above the blue, we would be in a buy. We would buy, but we've already got a position back here. So we've got our process rules, which we're going to deal with in a minute. But we would say, yeah, like let's buy. So we would look to the left and we would see, okay, here's our resistance level. So we're going to buy just above this guy right here. It's the first candle that actually closes above resistance. And what we're going to do is we're going to bring our stop all the way up to here. And we've got two positions. We've got two positions, but we've put the stop from our first position. It's well above our purchase price, which means then that that position is risk-free because our stop is above the purchase price. We have also crystallized some profit by having a stop above the purchase price on the first. And this is how we when we've got a strong trend, this is how we make significant return on what's called the big move without being riverboat gamblers, without needing to participate in the latest greatest fad, whatever that may be, which are typically stocks that move and jump all over the place, which if you want to use them, we will deal with that in the course, as long as you use a percentage of your portfolio and it becomes part of your process. But for now, I don't see what's wrong with making a really good return on a big stable stock like Apple, just by way of the technique that you use. So then your next question is, well, when are we getting out of this? Well, we've got our stop, and here's what happens in this case is that right here we've got a high in price and it's not matched by a high in the rate of change, which is an alert for us. There's danger there, Will Robinson. And so what we do, and I'll show you a cleaner version on the next slide, but we put on a trend line, and as soon as there's a cross below it, we are out and of both positions, and profitable, and nice work by us. And as soon as you've got this situation, this divergence situation, your stop would change to a trailing stop anyway, so you would be out shortly, and that is very basically how you do it. And if you, like I said, if you order the PDF, there's no charge. It's on the, just click the get see more details button at the bottom of this page, and you can order that. And you could take a look at how we do all of this, how it was all done in real time, and so on. So that's your basic method, and now that we're out, we're waiting for our setup to occur again to get back in. So let's look at, because this is looking like a dog's breakfast now. So let's move on to the next slide. Okay, we had a quick look at divergence on the last slide with Apple, and here I want to show you a little bigger picture of divergence as it occurred on the S&P 500. This is a monthly chart, which means that each candle represents a month of price action. And this is a real sore point for me, and I tell the story in the course. This is really what got me going on teaching myself how the markets work, rather than relying on others to take care of my clients' money, as I watched during 2000 to 2002 as my clients' money sank like a stone, and it didn't need to. And let me show you why that was. So here we have the S&P rising to a high, and what we've got down here is the rate of change, the ROC, is not rising to a new high. It's unmatched. So you put a trend line on, and you're out when that trend line is crossed. That's my method. And I looked back after a couple of years of training and said, yeah, that's what I would do. And lo and behold, 2007, 2008, the same setup. We've got a high being created in the S&P, and we don't have a new high being created in the rate of change. Put on a trend line and get out as that is crossed. Now, some of you will remember that painful time, 2007, 2008, one of the biggest financial disasters in a long time. And I can tell you that I had all of my clients' money out and into cash. They did not lose a penny as this thing sank like a stone. And then we go on and carry on up into the next phase. And I want to point out here, when some of you are sort of like, and I've heard this a lot, well, we can, in the markets, they always tell you to buy and hold, it always comes back. If you had put money in back here at this high, it would have taken you 13 years to see any profit on that dollar. No one hangs around for that long. You need to take action, and that doesn't mean, like I said, turning into a riverboat gambler. You just need to be sensible and make your trades according to what you see. And buy and hold is like maybe the worst advice ever. And if people in the business are honest with you, they can show you 18 to 20 year periods throughout the last 100 years and further back, where stocks did nothing for anywhere, let's say 16 to 20 years, they did nothing. And you need to be aware that, yeah, sure, they come back. You got all day to wait. Well, good for you. And so now we move on to another high in the market over here, unmatched. And this is a big divergence here, and this was a big drop. And like I've heard mentioned, well, there were bigger drops. There have not been drops in that short a time with that many points, maybe 4 times since the 1880s. And so that was a significant event, and you were warned. And if you had gotten out just before this trend line, just after this trend line was crossed, you could have saved yourself some grief and prepared yourself to get back in on the next entry point, which we have covered a little bit, how to do that on a basic method. And during the course, we talk about how you would do that with patterns and a couple other methods, especially the method that we use where you don't have any indicators whatsoever. You're dealing with a chart with squat on it, just the price, and I'll show you how you do that. Okay, so now we're looking at a big pile of out of focus cash. You probably wonder, why am I looking at a big pile of out of focus cash? And that's because a lot of people, when they start trading or when they're trading, they're too concerned with the result. And I can tell you that if you are just concerned with the big pile of cash, that you will not get your hands on a big pile of cash. The process is key. The sausage grinder is key. You have to look after the sausage grinder the same as you have to look after your process, and whatever comes out of the other end comes out of the other end. And that is what we cover. That is a big part of what I teach, and that is following a process, sticking to a process. And if you want to join the 10% of profitable traders, then you will pay attention to this. If you don't do anything else, you will write out a process and you will stick to it. And if you want to drop me a line, there's going to be my email kicking around here somewhere. I'm really happy to help you with your own process. You want to send it to me, and I'll take a look at it and tell you what I think. But if you start following a process, then you're going to improve your trading immediately anyway. So just keep that in mind, and it is vital. So I've shown you a basic trading method, and so to keep you out of trouble here, you also need to pay attention to these two things. During the course, we're going to cover several rules that you need to follow. But for now, these are the two I want you to pay attention to. One is capital allocation. Each of your trades should be no greater than 10% of the portfolio, and your stop should be positioned so that your risk is no greater than 2% of the portfolio. That if the trade turned against you and you were stopped out, you would not lose more than 2%. And that is if you get that PDF that I mentioned earlier that goes through the trading blog for the last 3 or 4 months that it was in existence, you will see examples of this. And as far as risk management goes, you need to place a trade. When you place a trade, you need to place a stop every time, either a static stop or a trailing stop, and we talk about those, the advantages of each one, and why. If you want to be a consistent trader, you really have got to get to this. You may have to talk to your platform to make sure you're putting it on properly, but you really have to do this. Now we have now covered some of the basics that are in the course. There's a lot more, and we flesh out the things that we've touched on here. And if you've got any questions about any of this, I'll make sure my email address is down below, and you can drop me a line, and I hope you will take me up on this course, and see if we can improve your trading, make you profitable, make you consistent. And I would just like to thank you for listening. Take care of yourselves, and hopefully I'll see you soon. Bye now.